feedback they need. So I'll go ahead and let me turn out that light too, so it's easier to read. So again, there's a 3-line heading: who, what, and when. Name of the company, name of the financial statement, the date. Then revenues go first. Revenue, and now there's one, service revenue. It goes in the right-hand column because it is a total. It's it, right? Expenses then go next, and you itemize them in the left column and total in the right. So, and again, everything is right up here. Here's where the service revenue came from. Here's all the expenses. Here's the total expenses. This is where it came from. And then you get the net income, and here's where it came from. Does that make sense? Single line means you add or subtracted. Here you added, here you subtracted. The double line at the bottom. Everything's clearly labeled. Does that sound good? Superb, huh? Super. All right. You guys doing good? All right. What's the one we do next? Statement of owner's equity. So here's the format. So you have a statement of owner's equity. And I'll put that on the front so that our viewers at home can follow it. So in the statement of owner's equity, what you do is you have these, here's the general format. So for the statement of owner's equity, statement of owner's equity, what you do is you start out with the beginning capital. You add the increases, subtract the decreases, and that gives you the ending capital. What two things will increase the capital account? Investments and net income. So investment and a net income. And of course, don't forget, a net income is part of, revenue is part of net income, right? So those are the increases. What sort of things would decrease it? Withdrawal or a net loss, sure. All kind of. All right. Now, in this case, everybody okay with that? So that's the general format. Give you a minute because I see people are taking notes. Now, you can lift every dollar amount for every financial statement right off the worksheet with one exception: the beginning capital. Now, the balance in the capital account may include an investment, or it may not. So you actually have to go to the ledger and look. In this case, they don't give us a ledger, so we just have to use it. But let me pull this down, and I'll point that out and see how that works. So the only number you just can't lift right off it is the beginning capital. And the reason you can't is because this capital account right here may include an investment. And the only way you'll know that is to actually take a look at the ledger. Okay? In this case, we just have to use the 12 because that's all that's given. Every other dollar amount for every financial statement after that can just be lifted. So you start out with the 12, increase it by the net income. If there's a net income, there'll be no net loss, and the withdrawals are 6. With that hint, let me turn you loose, and then we'll put the answers up in a minute. Oh, wait. I'm sorry. No, just itemize that before you do that. So, can I, so itemize that. So, let me put them up here. So here, let me show you here. So in this case, here's what I mean by that. So in this case, what we did here, so here I itemized all of my expenses, here I total them. And all I'm doing here now is, these are just conventions, but because they're followed so rigorously, you can go anywhere in the United States, look at any income statement and know what it means, because all these conventions would be followed. And all, they're just ways of doing things. There's no rhyme or reason to it, or there doesn't have to be, maybe there is, but it doesn't make any difference. Just everybody does it this way so you can read an income statement. Or any financial statements for example. Actually, I see a quick look. You just wait for answers?
Well, I actually kind of have a question.
All right.
Does it matter the beginning capital and the owner's capital? Does it matter what?
Well, same thing. What you want to do is you want to itemize in the left, total in the right. So sometimes, let me take a look here and find an example in the textbook. Oh, here, nice job. Here we go. Now, in this case, what the deal is they put the two increases here, total them there. There was only one decrease that went there, so the increase consisted of those parts. Does that make sense?
Yes, sir.
Yeah. Here, here's all the expenses, here's the total expenses.
Okay. Great.
All right. Lily, you ready for some answers? All right, here you go. So now, what I'm doing here is the reason we have these arrows is I'm pointing out, so anyway, got a three-line head. Here's the beginning capital. Now, all we could use is the 12 because we don't have a ledger. Increase it by the net income, that gives you a subtotal of 19. Decrease it by the withdrawals, that gives you an ending capital of 13. And then the net income came from the income statement is what that means. Now, you probably could have done different, oh no, it probably would have been one column in this case because there's no, okay. Does that make sense? Give you a minute with that, see what questions there are. Let me make sure that thing is running. There should be a red dot.
Is there a red dot?
Yeah, there is a red dot.
Okay.
All right, and give you just a minute. Now, I'm going to leave this up here for those that are taking notes. Yeah,
Off subject, but will we have to fill out something like this for the test?
you might. Yeah, you might. All right, you guys doing good. Now, let's go ahead. What's the third financial statement you do? Balance sheet, right? So here's the general format for the balance sheet. Let me go ahead and put it on the board here. And the balance sheet, don't forget, the balance sheet is like the fundamental accounting equation. Well, it's identical, actually. So on the balance sheet, you have assets on one side, and you have liability and capital on the other. And of course, I could have used it. Capital is the capital, or I could have used the owner's equity. Could have used the owner's equity. It would have worked. And then you make sure that the two equal. And again, there's two bottom lines here. One for the total assets and one for those two added together. Does that make sense? All right. You guys want to go ahead and do a balance sheet? All right, let me put this here while I kind of got started. Sure, and if she was first, I'll be right with you, Sarah?
Oh, I
Oh, you're, okay. Okay, all right. Yeah.
Question. When I was looking at this, I remember we had,
Okay. We'll bring that up in either later today or today. And all plan instances, their assets is around 1 year for review from the system. But I'll bring that up later. If you're okay to hold on from that, it'll come up later today. Okay. And by the way, sure.
It's like, alright, so long as well. Yeah. Over here we never mind over because I think it's just up to here. The bill's right up too. I'm not sure because. Yeah, but for the balance sheet, because we already used the withdrawals and stuff like that for owner's equity. We put that on here for the liabilities part.
You guys, let me put up the answers. So here we have the, and I drew the arrow. Let me turn off the light, it'll be more readable. And then I drew the arrow to point out that the ending capital comes, ending capital comes from the statement of owner's equity. So again, it's got a 3-line heading. Here's the assets, cash, accounts receivable, etc. Now, here you have office equipment minus accumulated depreciation for a book value of 6, right? That makes sense? So you paid 8 for the equipment, it wore out a total of 2, and so here's where you get the 2. Okay. And so there's 6 left. That sound about right? This is the asset, this is the contra asset. Itemized on the left, total on the right. Okay. Over here, you have accounts payable of 4, unearned revenue of 1, wages payable of 1, for a total of 6. And then the capital came from the statement of owner's equity. Add those together, 1919. Everything's got a label. Sound good? All right. Sure. Yeah, and thanks for asking. All right, right. What questions are there? Any? Yeah. Thank you. Well, right here. So office equipment was 8, right?
What is it?
Accumulated depreciation? Does that sound about right? So office equipment accumulated depreciation, and this minus this is 6, that's the book value. And often you'll see the 6 here.
Mr. Wall, is the test going to go through all of chapter 5 to just up to
1
chapter
through 4. Just 1 through 4,
So then what are we doing Wednesday?
closing.
Where was the 6 from?
Well, what it is it's the book value for the equipment. So 8 minus 2 is 6.
Oh.
And I'm just curious, I heard a voice, but who asked that? All right, 8 minus 2 is 6. And that's the book value. See what questions there are. Any questions? All right, you guys doing good? All right, questions, comments? All right, let's go on to the next topic. So that's the worksheet. And we did the, and again, that's where you do the adjusted trial balance, where you calculate the adjustments, and then your life goes into the ledger, where you calculate the adjusted trial balance, and it's where you get the information for your financial statements. It's all in the worksheet. Yeah.
So, when we say unadjusted trial balance, that's when we're doing this
That's
part?
it. Yeah, exactly. So that's the ending balance of all of all the ledger accounts. Is where those numbers come from the ledger, and they're just the ending balance of the ledger. Yeah, Andrew? Bond two. It'll take me a minute to time.
Why is capital 13 if it says 12?
Oh, because it increased by, the way it came from the statement of owner's equity. So what it is, you see the one at, follow the arrow back? It came from here. And what it did was it increased by 7, which is the net income. So it did start out at 12. Then it increased by 7, which is the net income, came from the income statement. That made a subtotal of 19, and then there were $6 in withdrawals. That ended at 13. So it was increased by the net income and decreased by the withdrawals for a net increase of 1. Was there another hand up someplace over here? All right. If you guys are okay with that. Now this is found on page 148. And let's go over it. So what I'm going to show you here now is we're going to get more sophisticated here. Now this is a balance sheet. Let me put that up there. Okay. So this is a balance sheet. And look on page 148. All right, right here in the board. Now, what we're going to do here, let's see, how can I do this? So, let's see, here's page 148. So, basically what we're going to do now is, if you organize your balance sheet in the way we're going through, it really helps you understand what's going on in the business. And I'll show you why in a minute. Okay? So here's what you do, so by way of an overview. Assets, again, just as before, you have assets, liabilities, and owner's equity, just as before, right? But what's different now is the assets are broken into categories, and so are the liabilities. So assets are broken into current assets, long-term investments, plant assets, intangible assets, so they're different categories. And liabilities are broken into current liabilities and long-term liabilities, and equity, it's in this case it'll stay the same, it just comes from the statement of owner's equity. Okay? So let's go up here to assets. Now, I'll make this a little bigger so we can kind of concept, so it's easier to read. So these are the assets, and here's the categories. So let's start with the top category. Let's start up here with current assets. Okay. Now, I think the way to do this is let's go ahead and get the categories down, and then either at the end of today and maybe the beginning of the next class, I'll show you why it's so helpful in understanding how the business is doing. Because it enables you to do the ratios, and I'll just show you how we're working with it. Let's start with the categories so we have something to build up. So up here we have assets, and here we have current assets. So let's start there. So I'm going to turn on the lights. I think I can put it over here. Okay. I'll turn the camera around. Excuse me. And, excuse me, Lily, I didn't mean to step on your foot there. All right. There we go. All right, so let's start with that top one, the current assets. Now, current assets are those that will be used up or converted into cash within 1 year of a business cycle, which is ever longer. So it's current assets. They'll be used up or converted into cash within 1 year or a business cycle whichever is longer. So in this case, we have things like cash. Of course, cash is cash. Short-term investments. Now, those are things like, what happens there is you made a sale. You got some extra cash. So you put it in a money market or a CD, something like that. And pretty soon you're going to buy some more merchandise with it. So it's only in there for a short period of time. Accounts receivable. You completed a job, you sent a bill, you're waiting to be paid, should be 30 days. Inventory. In this case, they expect to sell the inventory within a year. Prepaid expenses like insurance, you buy a year's insurance policy. So those are examples of current assets. So they'll be used up, a year's insurance policy will be used up within a year, or converted into cash like accounts receivable within 1 year, or a business cycle. Now, a business cycle is cash to cash. So what you do is you own a store. You spend cash to buy merchandise, sell it to the customer, collect your cash from the customer. That's a business cycle, cash to cash. So a business cycle is cash to cash. So when we say a business cycle, whichever is longer, so for instance, Boeing, when they build a plane, they buy the parts, make the plane, sell the plane, collect it. That takes them 2 years. So their current assets are those assets that will be used up and converted into cash within 2 years, because the business cycle is longer than a year. Okay? And I'll show you why this is so helpful in understanding the health of your business. Okay? The next thing is long-term investments. So here we have current assets. That's one category of asset. Long-term investments is another category. Now, long-term investments. If a current asset is used up and converted into cash 1 year, what do you think a long-term is? Greater than a year or a business cycle. Okay? So long-term investments are, they're long-term, and by that means greater than a year, and not used in the business. Okay? So what happens here is, you ran across a really good deal, right, on a piece of land. And so you buy it, and land you got to keep for a while. It's hard to flip land. So you buy it and you're gonna keep it for a year. It's not used in the business, it's an investment, and you expect to have that around for more than a year. And by the way, long-term and short-term, we're talking about management's intentions here. Okay? So a long-term investment, an example would be land you buy as an investment. Or suppose you have 2 factories. One factory you're not using, and at some point in greater than a year you expect to sell it, but you're going to keep it around for a year. That would be a long-term investment. So it's a long-term asset that's not used in the business. Okay? Then, yeah, David?
What if it's long-term but it is used? Is it like, what if,
Oh, that's a plant asset.
oh,
Listen, let me make sure, let me keep these in the same order as your book, just so we don't confuse, okay. So now a plant asset, okay, it's long-term and used in the business. So, in other words, if you own a factory, that would be an example of a plant asset. Or you own a car, that would be a plant asset. But a plant asset is one that's long-term, meaning it'll be around for more than a year, or a business cycle which is ever greater, and it's used in the business. Okay, does that sound good? All right. And then the last category they have up here are intangible assets. Now, these are assets that confer rights. So they're intangible, meaning they have no physical substance. So what we're talking about are things like a patent, a copyright, a franchise, that sort of a thing. So an intangible asset is something that gives you rights. Now, accounts receivable is intangible, right? But you don't have any rights unless you got the rights to money. Rather, we're talking about a copyright, we're talking about a franchise, we're talking about a patent, that sort of a thing, right? Okay? So it's intangible, there's no physical substance. We expect to have it for more than a year, it's long-term, and we have some sort of a right on it. So if we have a copyrighted work, we have the exclusive right to use it. Okay? If something's copyrighted. Or if we have patented, it's the same sort of thing. Okay? Now, why is this advantageous? Somebody is thinking, who cares? Sarah, was that you?
No, I was legit.
Evelina, was that you? Oh, wasn't you? All right. Kelsey, wasn't you? All right. Okay. Somebody. Oh, there we go. Is it Ollie? Allie. Okay, Allie. Okay. That grin kind of stuck. Okay, you never. Shelley? Is that you too? Somebody thought, who cares? I'll show you who cares. All right. So let's do this. Now, let's kind of go through this. So in this case, the ratio for this chapter is the current ratio. Okay? So, what the current ratio, well, let's look at the quick ratio. That'll be a better one. That'll give a better. So what happens with the quick ratio is the fact that on the quick ratio, it's quick assets divided by current liabilities. Now, quick assets are those that are turned into cash in the very short term. So in this case, what we're talking about is we're talking about cash. I'm going to put ST for short-term investments. Let me put S-term investments, or I'll put S investments, meaning short-term investments. And accounts receivable. Okay? That's divided by current liabilities. Now, current liabilities are those liabilities that you're going to pay within a year. Yeah.
Where are you? Like on the...
Oh, right here. I'm getting there.
Oh, okay.
Yeah, I'm getting there. Okay. So, basically, and that's a good question. So in this case, what it is here we have cash. So I was just going to give you the background and then plug in the numbers. So in this case, the cash was 6,500. And let me give you a good answer. The ratio for this chapter is one of the ratios to the current ratio, right? And what I'm doing here is I'm saying that when we organize a balance sheet with these categories, it will really be helpful in understanding the balance sheet, right? And the reason this helps you is the fact that then you can do the ratios. And what a ratio does is it just compares things, it puts them in context. A number by itself is hard to make sense of. But if you put it in context, you just start by comparing it with at least one other number in the financial statements and then something in the real world. Now the asset test, what it does is these quick assets are used to pay off the liabilities that are due in the very near future, right? So it should be at least 1-to-1. Now, I'll be right with you. Let's go through a little story here. Suppose you're the vice president of your union and you're kind of hurt with management. You're sitting around the council and somebody says, what about a strike? You say, listen, let's take a look at their balance sheet. And if they have enough cash to pay the bills that are due in the near future, I think they can outweigh us. If by contrast, if they're short of cash compared to their bills, they're vulnerable. Okay? And that's how you do something like this. And that's why organizing it in this way enables you to make those decisions. And that would be an example of this. Now, and I haven't forgotten you, but in this case, what it is I thought that was an example, but what it is, if you were going to invest in this company, and their quick ratio, which is also called the asset test, is greater than 1, then you can feel confident that they can survive something like a natural disaster, or a strike, or something that will close their doors. And they can be around long enough to get back on their feet. Yeah?
Where you have equals to cash, what is that a S dot investments?
Oh, this is short-term. Yeah, short-term investments. And that's where you made a sale, put your money in a CD until you could buy more merchandise. Now, let's take a look here. So what happens here is cash is 6,500. Yeah, David?
I was just wondering if there's a difference between quick assets and current assets.
Yeah, current assets are all those that will be used up within a year or an operating cycle, whichever longer. Quick assets are those that can be turned into cash immediately.
Most of them.
They're more liquid.
Yeah, this is most liquid.
Yeah, we'll turn into cash immediately. So, in other words, if there's a strike, here's our cash, here's our money in money market funds, and we expect to get a portion of our customers are going to pay us.
Accounts receivable is liquid.
Mm-hmm.
I have a hard time understanding that, because if you don't have the money, how is that liquid?
Well, you would only sell merchandise, you would only extend credit to people who you were very sure would pay you. Now, you may not want to include all your accounts receivable because some of these people won't pay you, but 80%, 90% should be a good estimate of what they're, whatever.
Should look like plans to keep the track record.
All right. So in this case, what we have here is the cash is 6,500. I'm going to move that thing so it starts making sense. By the way, you guys, never miss a class, because man, we go over a lot of material in here, don't we? All right. So in this case, what we have here is we have cash of 6,500. Okay, where did I put my notes? Oh, here they are. All right. So we have cash of 6,500. We have short-term investments of 2,100. And we have accounts receivable of 4,400. So this is the cash we have in the very near future. Okay? And you'll find they're all part of the current assets. We've already separated them out. And they're the top 3 because these are okay. Then we'll go down and we'll find our current liabilities. Now that's right down here. So here we have liabilities, and here we have current liabilities, and the total current liabilities is $29,000. Okay? So that comes to $29,000. Well, when you work this out, it turns out to be 13,000 over 29,000, that comes out to be 0.45. So in this case, what it is this business is having a problem with being liquid enough. So if you were that vice president of the union and you were sitting around the executive cabinet and says, should we strike? You take a look at their balance sheet, and this enables you to analyze the balance sheet, and you say, listen, I think they're vulnerable, right? So if a threat of a strike is legitimate, because they can't be around, they don't have enough money to pay their bills for very long, okay? If it was 2 to 1, they could be around a long time, okay? Does that make sense? And so organizing your balance sheet in this way enables you to make decisions like these, okay? All right. Lauren, can I check with you? Does that answer your question?
How did you know which ones were quick assets?
It'll actually, a quick asset, if the definition of a quick asset are those that are currently cash or really near to cash, we're sure we can get our money real quick.
How do you know that merchandise inventory isn't also?
Well,
or is it?
the deal is, our door is closed, we can't sell to the customer. But we can cash in our money market, and the customers who owe us money had better pay us, or we'll pay them before. And these we can count on. Now, you may want to divide it up differently. You might say, listen, yeah, that's a good question. All right, you guys doing good? Everybody got their questions answered? All right, and so what we're doing now is we're organizing our balance sheet in such a way that we can analyze the health of a company. And that's one example where it pays off. Now, what we did is we just went through the assets. Liabilities are also divided into category, and they're divided into 2 categories, current and long-term. Now, I sense ennui. All right, ennui means you're kind of sleepy. Everybody's brain is full. All right, well, this will build up stamina. All right, Steve, how you doing there? Doing good? Yeah. All right, okay. All right, sounds good. Arthur, you doing good over there? Okay, good. Yeah.
Can you explain
Lauren?
this real quick? The 0.45, so because it's less than 1?
Well, as a general rule, with a quick ratio, you want it to be 1 or greater, okay? And the reason you want it to be 1 or greater is because you want your cash and those that could be converted to cash real quick to pay your current liabilities, the liabilities that are due within a year. And that means that if you're going to invest in this company and they had a quick ratio of 1, it means that if there's something that shuts their doors down, a strike, a boycott, a natural disaster like Mount St. Helens, you know, or the hurricane, the hurricane down in New Orleans, etc., then they can be around, they can get back on their feet. In this case, they may not be able to get back on their feet because they just don't have enough cash to pay the bill, and their creditors are going to want their money. So they may not be able to get back on their feet had they been victims of good treatment. And these are, and I appreciate your questions, these are good questions. You guys doing good? All right. Now, let's do this. So we talked about the assets, right? Let's get into the liabilities. And these are the assets. The liabilities fall in 2 categories. And let me just see if I can squeeze it in here so when we have a review, we'll be on board. So now we're going to talk about liability. And there's 2 categories. There's current and there's long-term. What do you think? What's a current liability? It's got to be paid within 1 year. Well, if it's due in a year. Or a business cycle which is ever longer, and I'll leave that out, okay? A long term is due after a year. Okay? So in this case, a current would be accounts payable, 30 days. Your mortgage is 30 years, your mortgage would fall in this category. Does that sound about right? And the current portion long-term debt. So So in this case, you got a 30-year mortgage. Year 1 is a current liability. Year 2 through 30, the next 29 are long-term liabilities because they're due after a year. And by organizing it in this way, you can then start to make sense of your financial statements. Does that make sense? Now you guys, let's have a quick review. Moved into long-term memory. So back here we started with the accounting cycle. Business transaction, source document, journalize, post to the ledger. Now, then we did the unadjusted trial balance, we did the adjustments, make them current, we do the adjusted trial balance, and then we do the financial statements. All of these are done on a worksheet, okay? And a worksheet looks like this. It has 5 pairs of columns. So on the worksheet, here's where we actually calculate the unadjusted trial balance. And so where we start in this is we get the ending balance in all our ledger accounts and put them here in this in the left column. Verify our debits or credits. That's where we do our adjusted. That's where we do our trial balance. Here's where we calculate the adjustments. Then we combine the adjustments with the unadjusted trial balance to get the adjusted trial balance. So these are current. So these are the ones we use to create our financial statements, right? Now, using these current ones on the adjusted trial balance, revenue and expenses go to the income statement, everything else goes to the balance sheet. On the income statement, here's our total expenses, they'll be the debits. Here's our total credit, that'll be the revenue. The difference is our net income or net loss. Put it on the side of the smaller and add them back. Now everything that didn't go to the income statement does go to the balance sheet in the next one. And an easy one to miss is, don't forget, wages payable is a liability, so it goes down here. You add them up, they won't equal, but when you carry the net income or net loss forward, put it on the side of the smaller, and that equals, all of this cross-footing has been verified. Okay? Then we just use it, we journalize the adjustments using this. We copy this into the income statement, and then we copy this into the statement of owner's equity in the balance sheet. And the only number you just can't copy right from the worksheet is the beginning capital, because it may contain an investment and you've got to go to the ledger to see if it did, because you've got to report that in the statement of owner's equity. Then we talked about the classified balance sheet. And the classified balance sheet, we're going to start dividing this into categories. And when we do that, we can analyze a business a lot easier. So now asset is divided into 4 categories. Your textbook uses 4. So current assets are those that will be used up or converted into cash within a year, or an operating cycle, which is ever longer. An operating cycle is cash to cash. So Boeing spends money to buy parts, makes the plane, sells, collects. That's their operating cycle. It's greater than a year. It's 2 years. Long-term investments are investments, like here they have a note receivable, land held for future expansion. So they're long-term assets that are not used in the business. Planned assets are also long-term, but they are used in the business, like equipment, land, etc. Intangible assets are assets that confer rights, such as a copyright, a patent, that sort of thing. Liabilities are also divided into 2 categories. Current liabilities are those that are due within a year. Long-term liabilities will be due after a year. And of course, current liabilities include the current portion of long-term liability. So you have a 30-year mortgage. Year 1 is a current liability that's due within a year. Year 2 through 30 are a long-term liability that are due after a year. You guys, you deserve a lot of credit. We sure made a lot of progress today. We're pretty much, any questions? No, seriously, yeah. Nice job, you guys. All right, well listen, we did a lot in here, so we'll go ahead and we'll see you on Wednesday. Okay? And we'll get into closing. Excuse me, I'm going to hit the stop button on this.